Let me ask you about the European economy, because we've just seen this headline saying that we've seen a new level on European gas prices, or at least back up to levels we haven't seen since early March. This is alarming for those following the European gas story. What is the downside risk for the European economy for you?
Oh, hello, good morning. And yes, it's a very significant downside risk. I mean, in our baseline projections we just released today, we forecast that growth in the euro area is going to slow down to 1.2% next year in 2023. But we highlight that in case there would be a full shutdown of Russian gas flows to Europe, the downgrade could be much more severe by another 0.8 to about 2 percentage point downgrade in terms of the economic activity for the area.
What do you think would actually, what are the chances of that actually being even lower? If you've had to revise it down, the forecast twice in the last few months, what's your worst base case and how quickly could we get there?
Well, this is why this time we have released both our baseline scenario and what we call an alternative scenario that highlights a number of plausible downside risks. And one of these plausible downside risks is this scenario of a full shutdown of Russian gas flows to Europe. So we view it as quite likely, but of course not as likely as the baseline still. There's still hope that somehow gas could still be flowing to the euro area.
Are there parts of the Eurozone, Pierre-Olivier, that now you do assume will be in recession? Of course, we focus a lot, our thinking here, on Germany. And can European countries, the EU 27 working together, can they prevent the worst-case scenarios from developing here?
Yes, in some separate set of simulations that the fund has been running, we actually look at what happens if we have effective sharing of gas resources, and it can mitigate and absorb, of course, some of the impact, as well as securing some alternative supplies, LNG supplies from other countries. So all of these mitigating policies will have an impact and will help the European economies.
How close is the U.S. going to come to a recession?
Well, in our baseline, we're not seeing a recession in the U.S. either in 2022 or 2023. We are seeing a significant slowdown from 2.3% in 2022 to 1% in 2023. So this is a quite significant slowdown. And just to give you an idea on, if we look at Q4 to Q4, in 2023, growth slows down to 0.6%. So this is a very low number. And what we're seeing is a very narrow path for the U.S. economy to avoid a recession at this stage. A small shock, a small downside risk could be enough to knock it off.
Okay, so that's where we are on the United States. What about the definition of recession, if I could take you there, Pierre-Olivier? Because it seems that as we sit on the precipice of perhaps seeing a technical recession in the US, that will then provoke a lot of conversations about whether it's possible to call it that when unemployment is as low as it is and the labour market as healthy as it is. How do you tie in the labour market and weak growth?
Yes, I mean, the U.S. is in a situation where the labor market right now is very tight. We have unemployment rates that are at levels that we had before the pandemic, 3.6%, very robust, hiring, lots of job vacancies. So certainly the labor market is very vibrant right now. But we anticipate that as some of the factors that we've highlighted in our update are coming to play out. The fact that inflation is eroding purchasing power, there's more uncertainty, consumer confidence is coming down, and central banks are also tightening monetary policy, then the labor market is also going to evolve and soften, and we may even see an increase in the unemployment rate sometime in 2023.
Pierre-Olivier, I wanted to understand sort of what's the base case for the Fed in your base outlook?
Well, what we are recommending at this point is we're saying, look, inflation at the levels at which we're seeing them in the U.S. or the European economies and other parts of the world as well is just something that generates a lot of instability, macroeconomic instability. It's eroding purchasing power. It's creating uncertainty. It's really not conducive to solid economic growth going forward. So it's very important that central banks bring back price stability. And this is what the Fed and other central banks around the world are doing. And our recommendation here is that they need to stay the course until inflation is tamed and brought back to closer to the central bank targets.
So the focus on inflation is the right fight to be having right now, Pierre-Olivier.
In our opinion, it is. It will have an impact on economic activity right now, but it will secure better foundations for growth and macroeconomic stability down the road. One has to remember that the era that we had over the last 40 years of low inflation, price stability, has been really an important ingredient to macroeconomic conditions. And we need to make sure that we don't enter into an era of high inflation. Yeah. It's really very critical.
Before we let you go, you also had a ton of risks in your outlook. And I didn't feel good after reading your report because of it. What's the one risk that people aren't talking about that we need to be talking about?
Well, we highlight, as you point out, we highlight a number of risks. I mean, I think one of the ones that worries us, I mean, it's not that people are not talking about it, but so far it's been holding up pretty well, is the impact of financial tightening on emerging market and developing economies. There's been a significant amount of tightening already. We've seen capital flowing out. We've seen currency, the dollar, appreciating against most other currencies. We've seen spreads increasing in many countries. But so far, it's been quite orderly. And I think that this has certainly been good news, but we are concerned that we could see some more dislocation in global financial markets on the back of this strong monetary tightening that we're seeing in a number of advanced economies. So we have to be vigilant on this.